Silver and the miners generally lead in both directions, the gold price. Now the question is not if we're going into recession. The question is, how bad is it going to be?
Today, we are fortunate to be joined by Dave Erfle. He writes a newsletter, The Junior Mining Junkie, also writes a weekly column for Kitco. I think he probably does a lot more. I'll let him tell you about that. But Dave is somebody in the gold and silver mining sector, the precious metal sector, that I've followed for at least the last 10 years. He's someone that always struck me as honest, upfront, respectable. So it's a real honor, and we're fortunate to have you here. Welcome to Ron's Basement, Dave.
Hey, Ron, thanks a lot for that great intro. I appreciate it. Great to be here.
You know, like I said, I've been heavily involved in this sector for a decade, and when I see an interview pop up with your name, I'm always sure to watch it. So on behalf of my viewers, thanks for joining us. What do you think? I have a theory that we're possibly in the early innings of stagflation here in the United States, and we know that's been traditionally a very fertile soil for the price of gold and silver and the mining stocks, if we if we look back at history. And as the menu of attractive stagflation, I think, kind of constricts the menu of attractive investment options for, you know, general stocks don't look so well, profit margins get squeezed, bonds don't look so good, gold and silver become more attractive. You know, it always kind of filters back, kind of like that Exter's pyramid, back to the real things. And as that happens, the sector, I think it's important, and I'd love to hear your input, your commentary on this. The sector in general is so small. I forget the statistic, but you know, when you take the entire precious metal mining sector, I don't know, like it's less than the cash balance of Apple or some crazy, or the market cap. I mean,
well, there's about half of 1% of funds are basically, I mean, of capital is in this sector. Half of 1%, and of that half of 1%, 2 to 3%, you know, are taken up by funds in the market. There's just so much room to get in.
Yeah.
Absolutely. And if you take, you know, a good thing to measure it by, how hated and how ignored this sector has become, is volume. Yeah. If you take a look at the volume on the TSX venture, I know the venture is only about half mining stocks now, but if you take a look at the volume on the venture now is the lowest it's been since the gold price was at $200 an ounce in 2001. It's that low.
Wow. So while it's painful right now that volumes are so low on the TSX, and that we only have 0.5% of investable capital, the good way to look at it is it's a heck of a lot easier to quadruple or go up by 6 times from 0.5% than it is from, let's say, 6%. Right. Trying to drive that, I try to drive that home to my viewers as well. Like, you know,
and we've been saying that for quite a long time, quite a long time. And all we've needed is the gold price to cooperate at the same time. And now we've finally got that. We've got that cup and handle situation on the gold chart, a 12-year cup and handle. Not only that, but you've got a cup and handle pattern inside the 3-year cup on the weekly chart. So you've got a cup and handle pattern on the weekly chart that's about to break out. And you've got a cup and handle on the monthly chart, long-term monthly chart of 12 years that's about to break out. You've got cup and handles on the GDX, on the GDXJ, you know, but the volume still really isn't there. You know, we've had some volume spikes, but the volume not there is telling you that generalists they just don't care. They still don't care. And a big reason over the past 10 years why they haven't cared has been crypto, right? All the speculative money was going into crypto. So we had that to contend with. So, you know, the past decade has been very challenging. I've managed to make money for myself and my subscribers for the past decade, miraculously.
Right.
But, you know, we're all setting up to profit from what's about to happen. I mean, I've been accumulating stocks for the past several months, you know, in anticipation of this. And you know, but the good thing about that is you've had the time to do it. You know, gold stocks, they have this cycle. They have this cycle of 7 years. They bottom every 7 years. 2001 major bottom, 2008 major bottom, late 2015 major bottom, 2022 major bottom. And if you can accumulate into and around those major bottoms with, you know, in a cash account, no margin, right? You accumulate into those major bottoms very well coming out of them. Each time in 2001, if you did it into 2001, you made a lot of money. If you did it into 2008, you made considerably more money because it was a spike low, right? And if you did it in late 2015, you made a lot of money in 6 months.
Yeah, right.
Right?
Because I remember
basically in the past decade, the mining sector has consisted of 6-month bull markets and 3-year bear markets. While it's been consolidating and building this base to go higher once the gold price gets above $2,000 an ounce. And we're almost there.
and you said it earlier, and right, you know, there's no guarantees, no crystal ball, right? But it feels like
that wouldn't be any fun.
No, right. Yeah, right. That's right. We wouldn't have anything to talk about now.
No, that wouldn't be any fun.
Yeah. But it feels like to me that there's a confluence of factors on many levels which are supportive or bullish for the mining sector, for the price of the metals. And, you know, whether we look at it from a technical perspective, a fundamental perspective, a geopolitical perspective, a basic mathematic perspective, if we think about things like the national debt and just, you know, the bubblegum duct tape, you know, kind of monetary policy that's gone. I mean, it just seems like there's a confluence of factors that are good for the price of silver and gold and the mining stocks.
Right. And all the things that are supposed to happen before the gold price breaks out are happening. You're having silver is leading the gold price. The miners are leading gold price. I mean, silver and the miners generally lead in both directions the gold price.
Interesting.
So we're definitely seeing that. But as far as the mining sector is concerned, you know, it's short-term overbought. So I envision a scenario where you see the majors and the mid-tiers and the royalty streamers, you know, they start to have some profit taking, and that profit taking leads to rotation into juniors. That's generally what happens at major bottoms, after major cumulative bottoms. You know, the miners run up first, the royalty streamers, they run up first, you know, and resource investors, they take some profit off the top because they understand how this works, and then they put it down into the juniors who've yet to move. So some of the juniors have moved, but a lot of them have yet to move. And as far as the juniors are concerned, they outperform. They outperform in both directions. You know, in bear markets, they outperform on the downside, and in bull markets, they outperform on the upside. And juniors are still underperforming because we've yet to break out. We've yet to have this breakout. And you'll know when it happens. You'll start to see these companies move up 10, 20, 30% sometimes in a day. You're starting to see it in a few of them. It's in select few, but it hasn't happened on a global scales. I mean on a sector-wide scale. So, you know, I call them dart throwers moves, right? I mean, where you could basically put a list of juniors on a dartboard, throw a dart, and you can make money. We haven't had that kind of move since March, April of 2020, and it only lasted 4.8 months.
Right.
And then that move, which went up 300%, has taken 3 years to consolidate almost. Wow. So, you know, that's not normal in this sector because the sector is still paying for the sins of the past, of when those majors, you know, bulked up their production profiles with uneconomic ounces in dilution. I mean, I can't stress that enough, and that's not talked about enough. But they've learned from the sins of their past, and they're doing the right things now. But it also makes them timid to pull the trigger on mergers and acquisitions, which need to happen, right? It started to happen again recently. It started to heat up, but we need a lot more of it.
Yeah. It's going to be interesting.
It's really good, and you're going to see more interesting and creative mergers and acquisitions, which you've seen recently. You've seen these mergers of equals of juniors that are trading at 52-week lows, and they get together and they understand that, hey, there's only so many checks that these capital market writers can write, so we have to consolidate, and the plan is to attract the generalist investor who's been out of this sector for the past decade, like I said.
First Mining Gold is a development company advancing two of the largest gold projects in Canada, Springpole in Ontario and Duparquet located in Quebec. Each already has 5 million ounces of gold reserves, but exploration initiatives are underway at both projects to find even more gold. First Mining is well-financed, has zero debt, and owns an interest in 4 additional Canadian gold development projects.
I think very likely, as other areas, other investment options become less attractive, I think naturally we could see more people coming into the gold and silver sector. But the other thing, I want to get your opinion. One final question, and you're a really hard guy to interview because you answered all my questions before I asked them.
I get on a roll and I get on a rant. I'm sorry. I just kind of go off on tangents.
I meant that as a joke. This has been great. But I was laughing because I thought, well, he answered all my questions. So what the heck? I won't even write them down next time. No, that was a joke. I hope you know. It's been an awesome interview. I want to talk about and get your opinion on, let's say, a mid-tier producer and how a higher gold price can be, how much more from a stock price perspective, but also a cash flow perspective, how a higher price in gold, let's say gold continues this breakout and goes to $2,400. If and a company that has all-in sustaining cost of, let's say, pretty high, let's say $1,800, that additional $400 per ounce from where we are today, right? I mean, let's say even when we went from 1,800 to 2,000, it is so significant. You're talking about tripling or quadrupling the amount of cash flow that these companies can generate. And if you look at a company, and I'm not sponsored by this company, but I do own the stock, but like a company like, let's say, Fortuna or Equinox, that has a growing production profile on top of that. So if you have a company that's making more money per ounce, plus they're generating more ounces, and then the third kicker being improved sentiment in the market. I mean, how much more money can be generated within that could draw a lot of attention. I mean, the generalist investors might wake up if they start seeing some really crazy profit numbers coming through.
Well, a key point to make about what you were just explaining is the all-in sustaining costs. And they've risen now to $1,300 an ounce on average. And a company like you mentioned, Equinox, their all-in sustaining cost is $1,700 an ounce.
Right.
So if the inflation continues to rise, that's going to make it difficult for investors to say to themselves, okay, I'm going to invest in this company because the gold price is now over $2,000 an ounce. It's rising, but is it going to continue to rise higher than inflation?
Right.
As you know, and I know, the government statistics of inflation are creative, to say the least, right?
Right.
I mean, if we go by John Williams' shadow stats, the way the government used to calculate inflation is a lot higher right now than they're telling us it is. So it all depends on these. It depends on these factors. The price of steel has come down considerably. The price of lumber has come down considerably. The price of oil has been cut in half. From the $130 a barrel it was about a year ago. But when you have Saudi Arabia come out earlier this week and say that they're going to tighten production because they want to keep the oil price elevated. That's another huge headache for the Fed on trying to keep inflation down.
Yeah.
So, inflation has to have somewhat of a containment aspect to it for those points of yours to be relevant to the generalist investor.
Right, because if the costs continue to creep up,
exactly, and that's what's been happening for the past 3 years, right? The gold price has basically gone nowhere for 3 years. Yet inflation has gone out of control.
Yeah.
So
right. So is the Fed boxed in? I have a box. Where'd it go?
They've been boxed in for quite some time. Yes.
Here's my box. Can you see that? Do not open. And inside the box, maybe you'll get a kick out of this. Hope I don't get in trouble for this. But inside the box is Jerome Powell. You said something that sparked oil, right? Like the Fed can't control the price of oil. The Fed can't control a lot of the supply side.
They can't control how much money the United States sends to Ukraine.
Right. Yeah. I mean,
they don't even mention it. So, they can't control all these things that are creating all this inflation. All they can control is the economic aspect out of it, right? They can create a recession, which they're doing a very good job of doing. So they're doing a great job of creating a recession. It's now the question is not if we're going into recession. The question is how bad is it going to be? Mm-hmm. And the gold price has obviously sniffed that out because the gold price, the gold sector does not do well going into recessions, but once we get into recession, that's when it really does well.
Mm-hmm. Right, because the Fed's biggest tool, obviously, to fight inflation is to raise interest rates.
Right.
Well, everybody said
if you take a look at the situation now, it's a lot like the situation in the 70s, right? I mean, okay, the gold price ran up to $200 an ounce when Nixon took us off the gold standard, right? And then the inflation started to really take hold, and the Fed started to raise interest rates to 4.75%, and then the gold price was cut in half, 50% correction down to $100, right? Fed had lost control. They had to start raising rates exponentially. The gold price took off with interest rates going up higher, and the gold price was moving with the stagflationary recession, right? Mm-hmm. But what took the gold price from $400 to $850 an ounce really quickly? It was Russia going into Afghanistan. And that was a geopolitical move, right? Mm-hmm. Same thing when Russia went into Ukraine. What happened? Gold price and the dollar went up together, and it was a blow-off move. Mm-hmm. It wasn't sustainable. Same thing when the gold price went from 400 to 850 on geopolitics, right? The world didn't end. Russia went into Afghanistan. Russia went into Ukraine. The world didn't end, right? It created a 20-year bear market in the gold price because it had gone up so far, so fast for geopolitical reasons. Now it's happening for economic reasons, which makes it sustainable.
Thank you. You summed it up. I like to say it feels to me, it feels different, but you added some substance to my just saying it feels different because it's sustainable. It's economic.
Because it is different. It's sustainable now because but on the other side of that, we're all gonna be hurting. That's as my late great friend Richard Russell said. In a bear market, everybody loses. It's the winners who lose the least.
Yeah. Thank you, Dave. Thank you.
Absolutely.
You've been a great. Now I want to ask you: are you accepting new subscribers to your newsletter at this time, or?
Yes, I have a cap of 500 because basically my service, I try to do what I ask my juniors to do, which is basically invest their own capital in their own company. So what I do is I invest my own capital into all the juniors that I recommend. And I do it after I tell my subscribers I'm going to buy it. So I give them a heads up. What I do is I write this detailed report. I send it out and I say, I'm going to be accumulating the stock starting tomorrow or whenever. So we all try to get in it at the same time. We accumulate at the same time, and we're all holding because we're all in it together. As we're all in this together. So, I don't take any money from companies. Any company that I talk about in my Kitco articles, any company that I talk about in interviews, if I own shares, I'll let you know about it. And this is basically how my service operates. It's an over-the-shoulder service. They know exactly what I bought when I bought it. All my transactions are published and updated every week in my weekly newsletter. So we can all try to make money together.
Does that set you apart from some of the other news? I'm not real familiar with the newsletter, but the fact that you tell your subscribers what you're going to buy before you buy it, is that set you apart from some of the other newsletter writers?
It did when I started it in April 2017, but I've seen several kind of try to copy my model,
emulate. Yeah, because it's fair.
Which is great. I'm happy to see that, because this is what we need in this newsletter space. Is we need more honesty. We need more people that are upfront about how they run their newsletters, about how they run their recommendations. Because if you're getting paid by a company to recommend it, you're biased. I mean, are you going to be telling your subscribers, hey, I'm going to sell this company because it's not doing the things they said they were going to do, or the project doesn't look viable? It's not management's fault. This is a tough business. For every discovery, only 1 out of 2,000 becomes a mine. So this is a very difficult business. There's so many reasons why a stock could fail. It's not only just management. So if that's happening, I'm going to sell it, and I'm going to tell my subscribers I'm going to sell it. And I can't do that if the company's paying me.
Right. So you are very transparent. Is that a good way to sum?
Absolutely. That's the only way to be. And, it's proven to be very successful. I can honestly tell you, Ron, I can count on 2 hands how many complaints I've had since I started the service in 2017. If I make a bad pick and I lose money on a stock, they see that, hey, I lost money, but hey, he lost money too. So what am I going to complain about? I know this is a very difficult sector. It's the baseball analogy. If Hall of Famers, there's Hall of Famers in the Baseball Hall of Fame that are batting 300. That means they failed 7 times at bat. So it's the same thing in the juniors. All it takes is a couple out of your basket that you've accumulated to do really well to cover up your mistakes. But you have to recognize those mistakes early and get out of them.
I will put a link to your website in the description of the video. If anybody's interested, they can reach out to you through the website. Is that safe?
I appreciate it. Thank you.
Yeah. Yes. Oh yeah. No, and thank you for joining us today. You have shared a wealth of knowledge and information and experience. And, I dive into this sector on a daily basis, and you opened a few new pathways as I was listening to you. You really have some great insight. And on behalf of my viewers, thank you, Dave.
Oh, it's been a pleasure. Anytime. I could talk junior stocks all day.
Yeah, we do well. Maybe we need to go to a couple cocktail parties together if somebody else to talk to, right?
Certainly.
All right, sir. Thank you, and we'll see you soon. Thanks, Dave.
Okay, have a good one, Ron.
You too, buddy.